Hi there, just read this disclaimer please. So the second of the three investment trusts that I was considering for the kind of alternative section of the portfolio, which would make up 8% in total, well 1/12, what's that, 8.3% or something like that. So the second one I was looking at was something that creates renewable energy. Again, as I say, it's something different. I didn't want to have another equity income investment trust, so I'm looking for something different. As a starting point, I kind of went to this section of the AIC's website and just looked at all of the different options. I mean, honestly, I can't really tell you why I select. Well, I can. It's hard to know what to look for, isn't it? As like an initial screening process. So what I've done is I've looked. I didn't fancy any of them that haven't been in existence for less than 5 years. So I've kind of ruled out from this point below, based on that. Who knows if that's the right decision? You know, I don't. It's hard to know, isn't it? You know, you've got to start somewhere though. So then I've sorted it by the 5-year performance. I had a quick look at the ongoing charges. All seem quite similar, around 1%. So it's not a massive differentiating factor there. And then dividends in the same kind of ballpark. You know. So of the top 3, a lot of them kind of specify whether it's solar or wind, and I kind of wanted to avoid that. Because basically, if in a certain circumstance, wind is much better than solar, I'd like the investment managers to make that decision for me. I don't want to choose myself, which is better, solar or wind. I'd rather people who know more about it make that decision. So for that reason, these top 2 I've excluded, and then quite kind of simply I've just gone for the next one down in the list. I mean, it's nice to see that the charges are a bit lower than the ones a bit lower in the list, but that wasn't really the determining factor really. So I mean, like I said before, I'm not going to be making these investments straight away. This is just my initial looks, to be honest. So I've been looking at the Renewables Infrastructure Group. It's coming up to 2 billion worth of assets, dividend yield of 5.4%, which I will check as always. 6.64 pence, divide by 1 to 5.2, 5.3%. So yeah, pretty accurate. So it's a nice little yield there. One thing to note is, as with this and the other one actually, all 3 of the ones I'm looking at. So in times of turmoil, they're kind of, what's the word I'm looking for? They're kind of, I mean, in this case, they've acted kind of as uncorrelated assets. So as everything else has tumbled and not really recovered properly, these seem to have done a much better job at recovering in these times. But obviously this probably isn't the moment to buy them, because I'd rather everything else, all of my other investment charts look like this first, before I started switching some of them to these kind of trusts where they're kind of uncorrelated and kind of steady. I don't expect it to shoot the lights out, but it might be like a steady kind of asset class to go for. One thing you'll notice here is the dividend cover says 1.72. When you look at investment trusts like City of London, Lowland, Murray International, those ones, I think they kind of do their accounting differently. So the numbers that are shown on this part of Hargreaves Lansdown websites are more as you would think. So for normal investment trusts that are just normal equity income ones, you can pretty much say that actually the revenue from the dividends or the other investments they might have is that number multiplied by that. But I think for normal companies, or for ones like this, that isn't an accurate representation, I don't think. I think that is actually including the revaluation of the assets as well as the income from the assets. Because if you look here at their the annual report from 2019, it says here cash generation and dividend cover remained healthy at 1.2 times, or 1.3 times after script's taken up. So that's like instead of paying you cash, they just give you a few extra shares and dilute everyone else. So 1.2 is the number. So actually they've only earned 20% more than the money they've paid out as a dividend, I think. I wasn't quite sure how these projects work. So if we look at their website, you can go to the portfolio section and have a look at some of the assets they own. As you can see, there's 45 wind projects, 28 solar and 1 battery storage. So as you can see there, some places in Europe as well as the UK. Also there's signs for solar, and obviously it kind of makes sense that the further north you go, the more solar there is and the fewer, the more wind there is and the fewer solar. Because, you know, obviously closer to the equator, Highlands of Scotland's probably windier than some other places as well. Oh, and further up there there's, oh, what is that? Is that Sweden or? Sweden, yeah. If you click into them there, you can see kind of pictures of them. How much, how many megawatts of electricity they, I presume that's just an estimate based on average weather patterns, I would guess. So you can just, but I mean, you can't really get proper in-depth information on each one. But what I'm not quite sure about is how the kind of ownership of these things work, and I've not really been able to find much detail on them. Because all it says is the commission date was 2003, and at some point, in part of the annual report, I found that it says that most of the projects are estimated to last between 25 and 30 years. But I'm not quite sure what happens at the end of that 25 or 30 years, because I think that's based on how long the equipment is estimated to last. I mean, to be honest, even if the equipment was still working, you would hope that after 25 years there would be better technology. So even if these wind farms are still producing electricity, you would hope that maybe if they just replaced them with newer ones, maybe the technology would have got better. Who knows? Maybe there's a diminishing return at some point. They can't really get much better. It's hard to tell, really, isn't it? So I'm not sure what happens after 25 years. I'm not sure if TRIG owns the land, for instance, or are they just leasing it for the time frame of the solar panels or the wind turbines? Because it would obviously it would be better for them if they own the land, and then the cost of replacing the equipment after 25 years would be less than having to go to a new location and buying land and then creating, or maybe it's not. Maybe taking down old ones and putting up new ones is more expensive anyway. So maybe it's better that they don't own the land. But I don't even know if they do or not, you see. I don't quite know how it works. So if anyone has any insight into this, I'd love to hear more about it in the comments section. So there's, you know, you can look at all of the different ones, but like I said, there's not much detail. And then if we go to the solar section, I think I just have to close that section and look at the solar PV. And see some details. See, solar is a much smaller portion of this portfolio. As you can see by these numbers, are much lower. I think there's a graph of that in the annual report somewhere, and then there's just 1 battery storage. Alright, so there's more details here on the portfolio. They list all of the projects and the year they were commissioned. So obviously you want these years to be higher because they'll have longer life left in them. So I assume that when they value the portfolio, part of the consideration must be the year they were commissioned. So, because obviously that influences how long left they've got of producing energy. So even if the energy prices go up, you've got to think that the net asset value must be adjusted each year for these becoming 1 year closer to the end of their life. So that's obviously why it's important that they reinvest the money, because that's why I was a bit concerned about making sure this number was accurate. Because if they were reinvesting 72% of their cash flow, that would be pretty good for future prospects, wouldn't it? But at 20% this year being reinvested isn't quite as nice to think about, is it? Now here we go. By country and power market. So there's a lot in Scotland, a lot in England and Wales, some in Germany, Sweden, France, and then by technology, as you can see, most of it's onshore wind, most of it's offshore, and then offshore wind as well. So the lion's share is wind. I mean, I just hope that is the best financially to do. So that's why I don't want to be making this choice myself. They must have good reason why they've got mostly wind, and then batteries just starting. By revenue, and here's the other thing. There's like lots of government, what's the word I'm looking for? But basically the blue ones are kind of fixed rates for the energy they supply. So if the price of energy goes down and they can get less for it, that stays fixed. And I think there's subsidies as well. That's what I was looking for, subsidies from governments as well. So the green ones are just based on market rates. So it's like the training wheels are taken off. So there's no government subsidies or fixed kind of promises of how much money they get paid for the energy they produce. So as usual, I haven't dug that deeply into it, but I'm just doing my best. In the annual reports, there is a chart for each year. That's why I've got the last 4 years' annual reports. And in the chart, it gives you this chart, which is the illustration of the split of project revenues by contract type and portfolio. So this is based on the portfolio each year. It's based on the portfolio as it stood in each of those years, or at the end of each of those years. And as you can see, from 2016, the revenue for all of the fixed ones, so what they call index fixed PPAs and FITs, whatever that means. Basically, the blue lines are more secure income, possibly include subsidies. So what I've done is I've aligned these up so that each year matches in terms of the time from. So if we drew a line down here, it would always be 18 years from the beginning. So I just wanted to see how this chart is developing over the last 4 years. So what I did was I drew some lines on it. So as you can see, I've drawn a line where the peak of the revenue is estimated to be, and I've drawn the bottom line as being in 20 years' time, what is our estimated revenue. And as you can see, it was somewhere in the region of 80 million, because this is what I'm thinking about, the longevity of it, you see. So 80 million in 20 years' time, and it stayed steady at roughly 80 million there. And then 2018, again, roughly 80 million. And then bang, there's a big jump up to roughly 240 million in 2019. Which isn't a surprise. Because if we look here, I've dug into the annual report and found this page. Right, so here we've got number of shares in issue at the end of the year. Because obviously, those revenues that are here are kind of meaningless. Because you buy a certain number of shares. You don't, and if other shares are created that dilute you, it doesn't help you, that number going up. So as you can see, the total number of shares in issue from 16 to 2019 has gone up heavily. So I've just inputted these numbers of number of shares, and I've put in their revenue, so that I've got here the next year's estimated revenue, which is that in each one. So 2017, 18, 19, 20. The peak revenue estimate and the revenue in 20 years' time estimate. And as you can see, this is the one I care most about, because I want to own things for the long term. And that was pretty steady and then suddenly jumped up, which makes sense because as you can see here, there's a massive jump in the number of shares. 1,200 to 1,600 and something. So there's a massive jump up, which makes sense. So that number is kind of flattering. So what I've done is I've just divided these three by the number of shares in issue. And as you can see, the next year's revenue estimate is pretty flat. And the peak is pretty flat too, going down a little bit actually. But the revenue in 20 years has jumped up a fair bit in the last year after going down a bit. But obviously these are all just estimates really, but it's nice to see that they're not going backwards, you know. It's not like one of these venture capital trusts where eventually the net asset value just gets run down to zero. You know, you just get paid everything in dividends. So there is some longevity there. But what you will notice is that the blue all disappears there in 37, pretty much. Actually 36. Why has it gone even lower? So it's obviously, I mean, I'd have to read more into it, but obviously I can only assume government subsidies and things like that are just kind of going to peter out as time goes by. Going back to this dividend cover, I haven't written it down, to be honest. Let me find it all out. The cash flow dividend cover, if you like, is roughly pretty flat, 1.2 to 1.25. This 1.25 might be somewhere. I got a little muddled up as to which report I was looking at and then typing it in the wrong place. So that might be one of these other years, but pretty flat. And it's good to see that there's a little bit of extra cash to reinvest, so that these charts don't always end up going lower and lower and lower. Because as you can see here, it's already gone higher at this 20-year point, and we want that to continue to happen per share, not just the total per share, because obviously they've been issuing equity to make more investments recently, haven't they? At some point that'll stop, and it will have to rely on its own earnings to grow their asset base. So it would have to rely on the numbers above 1 there. Anyway, there we go. There's the second one I'm looking at. Well, it was actually it was the second one. The song fund wasn't the first one. That was the third one actually. It's just the one I made the video on first. Alright, so there's that one. Let me know if there's anything I'm missing or misunderstanding about these things. Do you know if they own the land? Because I haven't been able to find that out. At some point I might take a deeper dive into these other ones. I don't know. Who knows? Like I say, it's not to be invested straight away. This is just me pondering for the future, really. Alright, that's it for today. I'll see you next time. Bye-bye.